All right. Looks like we're live. Welcome, everybody. Minus Investing live. A little bit late of a show. Late in the sense that I technically meant to do a show like 2 weeks ago, but uh, with trying to keep like an every other week schedule, but only a few shows into that, but had some kind of out of the blue social opportunities that I decided was more important than doing live streams in a particular week. But nonetheless, here we are to talk about kind of the results, some more earnings like we did with our last show. Though this time the discussion will be around companies in my own portfolio rather than just kind of interesting earnings releases kind of broadly in the market. So that'll be fun. Pretty much all of my portfolio has reported at this point. I'm still waiting on Mastercraft that's going to be reporting this week, and then Lennar is kind of an off-cycle reporter, so their earnings comes out a month from now. But technically speaking, that's like a very very early reporting of Q3 earnings. So like in a sense, they feels like they're a late reporter, but technically they're a very very early reporter. So um, yeah, kind of like looking at that, which of my earnings are coming up next. Technically, Mastercraft is the last one, which is this week, but they're obviously a much smaller portion of my portfolio. So yeah, we'll be discussing FG today, Generac. We'll be talking about my gold miners in my portfolio, also about PayPal and Hydric and Struggles. Um, all those are all pretty much my top positions. So that's pretty much the stuff to talk about to really get an idea of what's going on with the earnings in my company. So that's pretty good. And I think we'll talk about them kind of in order of when they release. um, my gold miners, we're going to kind of talk of them all as one. So in terms of when they were released, we'll consider it as the last one to release. Means that it might be one of the last ones we discuss. But so yeah, we'll talk about PayPal first. Oh, also before we get going too far, if you're watching either live or on the replay, I'd really appreciate it if you like the stream, subscribe to the channel if you're not already, hit the notification bell and all that. Also consider joining our free Discord. It's the pinned comment in the chat, but also there should be a link in the description below. Join our free Discord. There's a waiting room, and I have to manually enter you in, and sometimes it takes up to like a day or so for somebody to let you in. So be patient with it, but once you get in, like I said, it's free. Come be part of our daily discussions, what's going on in the markets, what's going on in our own portfolios, various investment ideas, actions of major investors, stuff like that, fundamental research behind various locations. So consider joining the free Discord. It's a great place to be for people who have interesting investment ideas and want to discuss it with other people. Also, if you for any reason would like to maybe support me personally, there's also PayPal or Patreon links as well. So consider that as an option as well if for some reason you would like to give me some sort of monetary support. Here in front of us, you can see kind of the bare bones of a new watch list I've been putting together. I kind of got rid of my previous uh, master watch list that I had been putting together for a long time, my dashboard that I had been previously trying to offer as something for people to subscribe to on my Patreon. But honestly, the method I was going about with that, I found way more difficult. So I've kind of begun putting a new one together, which you can kind of see here. But it's still in the early stages. I have like lots of things I want to do with it that I've kind of only just been going with. So we'll probably be talking about that over the coming months. But like I said, today we're talking about earnings. So anyway, as I said, we're going to talk about PayPal first. So coming over to PayPal's earnings deck, we'll talk a little bit about some stuff here. Scroll down a little bit. We'll start with the account activity metrics. So they're up to 438 million active accounts. Active account being any account that has transacted in the last year, which was kind of traditionally how PayPal always reported their account metrics, and year-over-year growth from the previous Q2 and 2024 quarter is 2%. And also monthly active accounts is also up about 2%, so you can see that the total amount of that is about half as much. This metric they finally started reporting with the new CEO, which has been great. It's one of those things that when you first start reporting it, it makes you look bad because it makes it clear that, oh wow, actually your activity is way lower than it previously seems, but it gives you a lot more credibility over time if you're willing to report much more much more minute, minor level detailed metrics like that. So I think it's been a very, very good choice for PayPal to start breaking down on the monthly active level. And that they required them to essentially bleed out accounts for some time as they essentially weeded out a lot of the less active accounts. And that took like really up to a year for that to kind of like slowly bleed through the system. But now they've gotten down to that lower base where they can get like a healthier base of growth off of, and that's really starting to show each quarter. We're getting year over year on the quarterly level as well as sequential monthly active account growth, which is great. Um, then we get down a little bit further, it gets a little bit more complicated with some of the metrics. See number of payment transactions also going up. And then you'll see that they also report payment transactions excluding the PSP portion of their business, which they also do for the transactions per active account, which makes sense. If you're going to do it for transactions, you might as well do it for transactions per active account. And you'll see here's the reason why they do that. If they report their transactions per active account, it's down year over year from the same quarter of 4% at 58.3 transactions. So this many monthly active accounts doing this many transactions times 12, per month times whatever the dollar amount is gets you your total payment volume. And so you can see like, great to have accounts going up, but if they're transacting less, then that's one of those key metrics that's going to go down with that. But if you exclude the PSP, you can see that it is actually up 4% year over year, just going to show that the PSP portion of their business is actually a little bit of a drag. And that's partially where some of that bleeding out has come from because they've had a larger amount of transactions. Because you can see 58.3 was the actual metric versus 35.6. So by excluding that, you actually drop the total transactions per account, which means the PSP portion of their business has a much larger volume of transactions, but they're a lot less lower of a dollar volume amount per transaction, which is why they've been wanting to do this bleed out. It's essentially like I said, you're lowering the total volume that your base is at, which looks bad in the short run, but you're creating a much more efficient, much more profitable payment volume to be working off of going forward. So it's one of those things where, and I do think this is part of the reaction of the stock, which you'll see here in a minute when I go to show the actual chart. The earnings reaction wasn't super great, and that's because I do think a lot of these headline numbers didn't necessarily look super good, but I do think it is kind of in line with the same thing that we saw, like I said, with the accounts. It looked bad for a few quarters, and here we are like a year later, and it's starting to actually look super good. And I think it's sort of the same thing you're going to see with the TPA X PSP versus the full TPA, and it's looking bad right now. But X PSP, it's very, very healthy, and so 2 3 quarters later, this is going to start to look more like this, or at least that's definitely how I'm perceiving it. There's other aspects of PayPal's business that's going to be a little bit more challenged on the kind of cost efficiency side, but in terms of the actual growth side of it, I do think things are looking reasonably healthy. So looking within that, here you can see total revenue for Q2 year over year, 5%. FX neutral still also 5%. I usually don't really care too much to pay super close attention to the FX neutral numbers that they report. So sometimes they report for some metrics and other ones not. Transaction margin, which is basically like their gross margin within that TPV, 7% growth. So you can see there's already some operational leverage that they're getting good there. They report 8% for the year-over-year growth, excluding interest on customer balances because they have to pay interest on that. So basically, they're arguing that because of the high interest rates, that they have to pay higher interest, and therefore that's a drag on the transaction margin growth. Blah 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 blah. Whatever. It's part of the operations. They wanted to have those interest balances only like a couple quarters ago, and it's a minor difference, 7 and 8%. So it's like personally, I think this is a funny exclusion to kind of quibble on your numbers about whatever. I'm happy with the 7% year-over-year growth. It's higher than the 5%. That's exactly what you sort of want to see already there. And then related expenses, year-over-year growth, non-transaction related expenses 2%, non-GAAP operating income, you can see year-over-year growth 13%. So further leverage on that, 5% to 7% to 13%. Non-GAAP operating margin increased 132 basis points, which is excellent. But as I kind of already alluded to previously, the payment space is extraordinarily competitive, and I don't necessarily expect that to become less so anytime soon. So we'll take the profitability in the short run, but we definitely aren't baking super high profitability growth into our assumptions about PayPal. In fact, we're assuming relatively conservative assumptions about profitability when it comes to PayPal. It's really just comes down to the revenue growth relative to that ability to maintain margins in an incredibly competitive space. But then anyway, going down the line further, you can see then it drops to non-GAAP EPS 18% year over year. So you know, very very competitive space. As I said, you can look at the drag that the PSP is doing on their overall transactions per account and the drag that that's creating on the overall payment volume. But overall, on the actual income statement, everything's looking beautiful. 5% leveraging to 7%, leveraging to 13%, leveraging to 18%. And these are non-GAAP measures, but even if you look at the GAAP measures, it changes the level, but it doesn't really change the year over year growth that much. It changes it like a little bit on a specific quarter, but if you just kind of look at like the broad trend overall, the growth rates are generally about the same. It just kind of shifts the level slightly. So coming down here to the guidance, uh, for the third quarter, they're guiding transaction margins to 3 to 5% growth, and like I said, they're having this excluding of interest, customer balance number, whatever, 3 to 5, whatever. That is what it is. I'll take that. It's lower than the 5% that we saw, or the 7% we saw. So interesting to see that they're baking that in there. And I'm pretty sure that they commented on that in the call, that technically by maintaining their margin to, or not the margin, by having their guidance the way it is relative to the growth they've seen in the first half, it does basically imply a more difficult, a more challenged second half. And one of the analysts asked about that, and they basically imply that that's kind of like residual tariff conservativeness that they're just kind of leaving baked in, and honestly, based off of the way they commented on it, means that it looks likely to be essentially a hurdle likely to be in the second half. So we'll see. Could be potential solid beats in the second half based off of these particular percentages here. And here you can see exactly what I mean. They did raise their guidance from the April amount of 4 to 5% of 2025 total growth up to 5 to 6%, but still nonetheless 5 to 6% for the year that they've given as of then, relative to again the 7% against the second quarter. So that means inherently that there has to be some sort of rollover in the third and fourth quarter to get down to 5 to 6%. That's kind of what we're talking about here. But anyway, like I said, probably conservative, probably going to beat this. What I'm reading into that. Don't want to make strong assumptions on that, but don't be surprised when it happens. Basically, what I'm saying. Um, Non-GAAP EPS, they're guiding 11 to 14% growth relative to 6 to 10% growth previously, and then the GAAP EPS you can see right here. It was kind of like I was saying. There's a level difference, but I didn't include the previous year number here, but I'm pretty sure if they included the growth number, it would still be give or take similar percentages, maybe 1 or 2 percentages off in either direction for those. Free cash flow, they didn't shift the changes for, which technically leads also to some sort of conservative assumption about the second half, potentially on the building of assets. But I also want to comment that that was one other detail I thought maybe the market was reacting to was some of the kind of the poor cash flow on the operating cash flow level that they reported here in the second quarter. This deck cash flow, operating cash flow. No, maybe not. I don't really want to go look for it right now, but you can see what I mean. The operating cash flow definitely for the quarter was a little bit on the weak side, but building up of other operating assets, which I think is likely related to probably the BNPL stuff. So honestly, I look at it as kind of noise on a single quarter level. Again, I think the market was probably more reacting to, like I was saying, the kind of fuzziness between the rollover on the transactions per active account here relative to excluding PSP or not. But either way, it does seem as though they're turning the corner within that portion of their business, PSP and Braintree. They commented in the call, TPV has turned the corner and will re-accelerate in the second half. Another thing that they were asked about on the call was the rollout of the big bank consumer data charges to be for access, and the CEO says that he believes it's immaterial to them and they won't really be impacted by this at all. There was definitely some negative sentiment when that news came out from Chase and other banks about them wanting to start charging for access. PayPal says that that's not really data that's really relevant to them. So, what he says. So either way, PayPal looking very good. Like I said, the market reaction not so much per se, but as you can see here, the reaction wasn't particularly pretty. And then here, the few weeks since the reaction, it's been a little bit weak. But I think it really just kind of some fuzziness over whether or not that PSP portion of their business really is turning the corner. and I think it is likely to do so. And to be honest, PayPal is one of those ones where I've definitely gotten less, I would say, bullish overall on their position within the industry and my belief that they have how much competitive um, share that they can take within a very competitive market overall. But I have been more and more impressed by the CEO. So it's kind of sort of been a little bit of a balancing act where I've almost become more or less bullish on the industry, but more bullish on just the CEO's um, drive to actually make a strong wealth for himself within this competitive space. So I don't. I'm kind of like looking to keep betting on him, and every time it drops, it's like okay, well that sort of alleviates my concerns to a certain extent because obviously valuation plays a pay and plays a role in it. So if the stock comes down, it means that now I assume the expected returns are even better. So when you get a reaction like this from the earnings, and I don't really see the earnings as that bad, it just kind of makes it like, oh, okay, well I guess we'll just keep sitting with it ahead of time. I did actually trim PayPal a little bit prior to earnings. Not a lot. It was a very small trim, but I did actually make a small trim prior to that. So that sort of in a way worked out. And I guess I could theoretically add, but I was trimming for allocation reasons, kind of readjusting my allocation system a bit. So doesn't mean I necessarily want to rush back into that. But all right, so let's move on from PayPal, uh, and we'll talk about well, I kind of want to go in struggle, but in order, but I don't want to go perfectly order. Generac was technically the next one to report, but we'll talk about Hydric and struggles next first. We'll talk about them instead first. A little bit less comments for them. They had a very strong quarter. I would say stronger than I was expecting. Definitely stronger than I think the market overall was expecting. A little pretty strong bounce back in kind of the consulting space broadly. I know I was tracking a lot of the employment numbers during the couple months where the Doge committee was doing a lot of layoffs in the federal government workspace, and there was a lot of canceling of consulting contracts. And there was a big reaction a lot of the bigger consulting stocks at the time. And I commented, I was like, well, this doesn't really affect Hydra struggles. So I don't really see an issue with it. But it was also one thing that I thought was funny that in the end, it didn't really affect those consulting firms either. The employment for consulting actually took off at a much faster clip once those federal layoffs occurred, which in a sense makes sense because those careers essentially fill in similar type work to government work. And so, in a sense, fire and lay off government workers, you're actually increasing the demand for that type of work. So, like I said, that's what happened in the employment numbers. I'm not really tracking the specific companies that do that type of work. I'm just following Hydric and Struggles, and they just do executive search, very specific niche type of consulting that isn't really relevant to, federal spending, really. I'm sure they receive some government money a little bit here or there, but it's probably a very very tiny amount relative to most holding. So point is that consulting has actually had a relatively good year, I think, relative to a lot of people's expectations. And Hydric and Struggles in particular is having a pretty good year so far. So um, uh, getting back to kind of to remind people exactly how their business is structured. As I said, they are focused primarily on executive search, which makes up the majority of their business. They also have two other segments: on demand talent, which is kind of as it sounds like is sort of like uh, temping, but for upper level management and executive positions. Then they also have Hydra Consulting, which is a little bit more of a broader consulting segment. And in many ways, I consider it as sort of like they're into the C suite to make sure that they essentially continue having meetings with all of the upper level managements to get in the know of when there are opportunities for executive search, specific things like that. Dan, hello, welcome to the stream. Yeah, yeah. Obviously, long time no see, but we technically chat quite a bit, but not so much on YouTube because my schedule's been haywire like crazy this year. But we're working on it. We're working on making things a little bit more regular. But yeah, here we are today, discussing the earnings of my companies and stuff. But anyway, getting back into it. But I bring up and mention up the split between their segments and how that plays into it because a lot of the surprise here in this particular quarter does in some ways come from these other segments. In my video talking about Hydric and Struggles Consulting, and me laying out my model and my expectations for them in the industry, I basically said that I wasn't gonna project major profitability increases for Hydra Consulting or On Demand Talent, which were essentially looking like loss leaders for the amount of data that we had for the company. And so I largely left them at basically no profits or even negative profitability for the On Demand Talent um, segment, and basically made it so the total profitability came specifically from the executive search portion of their business, which kind of flew in the face of some of the targets that they specifically had for their business model, because they themselves were saying that they were targeting 4 to 6% of organic revenue growth and 5 to 8% organic EBITDA growth, which implied EBITDA margins higher than they were already achieving, and that it was implied to be coming from scaling up of the on-demand talent platform, Hydric Consulting platform. And so that's the thing, is like it really comes down to, how much of the costs were fixed costs versus variable costs. And a lot of companies don't necessarily give you super specific detail on what is fixed costs versus variable costs, and that kind of leaves you to assume maybe that gross costs are going to be the variable costs, and that the operating costs are going to be fixed costs. But that's really just not a perfect way to estimate it. Technically, there's can be a mixture between both of them. So either way, the point is that I made a very conservative assumption in my original models, and I kind of knew that it was conservative at the time. But here in this quarter, they're kind of already showing that that's not the case. Specifically, they actually achieved profitability here in this quarter for the Hydra Consulting and on demand uh, segment. Specifically, to give you the actual numbers, they had total Q2 growth of 13.9%, adjusted EBITDA margin up to 10.7% compared to 10.4% in Q2 last year. That's the overall total company. And then executive search is up 13.4%. And also, specifically, there was growth in all regions. Their business is pretty international. They have quite a bit of business in Europe and a decent amount of business as well in Asia Pacific. Yeah, very, very international business. And so they had growth all in all regions too. So that's one thing that's pretty awesome to see, is that there's been kind of reigniting of the growth globally, not just here in the US. And the adjusted EBITDA within executive search, 22.9% versus 25.1% last year. So you can see right there that the EBITDA margin in executive search is literally twice as much as their overall EBITDA margin, showing that there is a drag coming from those other segments. And like I said previously, that drag was literally negative. But on demand talent up 14% revenue in the quarter from last year, growth in all regions. Adjusted EBITDA was 2.1% this quarter compared to negative 3.9% last year. So you can see a jump in profitability of 6 percentage points of EBITDA margin and into positive space. And then Hydra Consulting up 16% growth in all regions, and adjusted EBITDA 1.8% compared to negative 5.2% last year. So that's a 7% jump in profitability right there. So both of their loss leader segments actually became profitable in this particular quarter. And as I kind of mentioned there, growth in all regions in all three segments. So a very, very, very strong quarter for them overall. Very, very strong. Um, Q3 revenue guided to be 295 to 315 million, which implies a midpoint of 9.5% revenue growth from Q3 of last year. They spoke about higher levels of hiring in the second half, consistent with significantly higher consultant productivity seen in this quarter, giving them room to hire more in the back half. So I was saying that kind of a boost in profitability in this quarter. In some ways, they kind of implied that that was because they didn't hire as much in the first half of this year, is that they may have in previously, given what their expectations were. And so there's some potential for them to actually have a little bit of a bounce back and therefore lower that profitability bit in the coming quarter. Though that shouldn't be necessarily too much. And they're arguing that we shouldn't necessarily assume onward profitability within those other segments. But they have always been guiding that they were going to get to profitability within it. It was always my assumption to not assume that they were going to actually achieve long-term profitability. So they're saying, we shouldn't assume it's going to be profitable every quarter here on out, but that they do see this upward move as consistent with the upward trend in profitability for those segments. So very, very good to see. It is, it's a stock in my portfolio that is within a long-term kind of industry theme perspective in terms of how I think about the model for the company and the industry. But I don't have very, very high revenue growth expectations built in for the company, because there isn't really necessarily super tangible metrics in order to build that up off of, other than to just assume that they're going to grow their market share dramatically relative to other companies. And that's not necessarily a reasonable thing to just broadly assume. So I don't generally build models in that way. And I've also assumed that they could also acquire their way to further growth as well. But that's also something that I don't really model in either. So it's one of these companies that, like, technically speaking, when you look at my valuation for it, it's kind of sleepy in terms of we're not really assuming a huge amount of growth per se, and it really does just come down to the valuation at any given point. And I mean, looking at the actual stock, over the kind of long run, it does tend to zigzag quite a little bit, giving you opportunities to get a deal and to kind of swing some profits maybe on it as well. Though admittedly, the time frame in which I've held it, it has been pushing to now all-time highs. Or well, I should say all-time highs. Oh no, actually, it has achieved all-time highs now that I think about it. For a while there, it really wasn't quite all-time highs, but it was just at relative all-time highs for the last 20 years. But as you can see, actually now that I think about it, in the last month or two, it actually now has finally achieved all-time highs because it did indeed have a big old uh, published liftoff here in 2000 or so. But yeah, very, very, very good to see. For the time that I've held it, in many ways, it's definitely performed better than I expected, even though I did model out strong expectations for the company. But yeah, very, very happy to see it. We'll going to be riding the momentum in the short term, and I'll definitely be rethinking the valuation. But who knows? I might have to trim some of this one because, yeah, like I said, it definitely isn't stock that I have super strong expectations built in. It's been beating those expectations, but that doesn't necessarily make me want to make huge jumps in those assumptions either. So I might make some trim here on this at some point in the near future, but haven't done too much of that necessarily yet. Okay, so next, let's go on to talk about gold miners. Actually, we're now skipping all over the map. Now that I kind of skipped the order a little bit, we're actually skipping more than previously. We're going to talk about the gold miners in my portfolio, which includes New Gold. First, I guess New Gold here you can see. Um, yeah, taking off like a rocket, as you can see. Also, not technically at all-time highs because of crazy things that have happened in its past, but certainly at relative in the last 5 years highs for sure. Skyrocketing like crazy in the last year or so. But New Gold, as well as Silver Corp, which is technically mostly a silver producer, but is also a a expanding into gold even more and more so over time. They have recently made acquisitions that is expanding their gold exposure, so that they're becoming more and more of a gold entity, but they primarily sell silver and other base metals currently as of their current kind of revenue split. But then also I have Equinox, uh, or Orla. We'll say Orla first. Orla Mining, which has quite a bit of gold as well, and Equinox, which is one of my other ones as well. Um, and they're the split between them as well. There's a decent amount of copper as well. Kind of almost equal amount of copper as there is silver between all four of them. Like if you kind of just combine all four of them together and look at how much total gold production there is, total silver production, and total copper production, the silver and the copper is actually about equal. Which for to here, see, I've actually put that all together for the last several quarters. What I did is actually made a spreadsheet where I put together their production, the revenues, their all-in sustaining costs per ounce on byproduct basis, their cash flows from operations, their free cash flows, and their GAAP EPS on a quarterly basis, and then on kind of a trailing basis. And for Orla, New Gold, Silver Corp, and Equinox, and then for Silver Corp, well, I also included their silver production, and uh, for Orla, we also included for New Gold. We also included the copper production, and so I read it all together. I kind of made a separate sheet where basically I combined it all together to say like, what would it be like if we were thinking about my four mining companies as sort of one altogether? Because in a sense, that's kind of how I treat it in my portfolio. I selected these four companies because they had very specific traits about them that were different that balanced each other out. Like based off of where the locations of their mines are, I wanted to have like a certain amount of exposure in certain regions of the world relative to other regions of the world. And so, like between the four of them, they have a really good geographic mix. They also have a really good mix in terms of their cost structure for like their all-in sustaining costs. How much operating leverage do they get for their various metals? Some of them have very very high operating leverage, and other ones have much lower operating leverage, which basically means some of them have lower profitability right now, but could theoretically have much higher profitability as gold prices go up. And other ones have much higher profitability now, but have much lower upside potential as gold prices go up. That's kind of like what that implies. And then also there's a decent spread between the ore grading, which has to do with kind of the overall mining efficiency. So I literally selected these four companies based off of how they balance off against each other, and then also based off of my evaluations of the managements of each of them as well. So that's kind of what I did here is that because I used to be a big fan of wanting to own gold mining majors because I thought of that as sort of the low risk way to get a kind of broad diversified exposure widely, and I always recognize that individual mining companies have a lot of risk. But now my kind of new approach is what I do, and is built kind of like a specialized gold mining portfolio within my overall stock portfolio. That's kind of what I've done here. Anyway, the point is, like I said, for this earnings, I wanted to actually kind of show that, and I put together like the last 2 years of rolling quarters or so of kind of like all the metrics for all four of them on an aggregated basis. So you can kind of see like what's really happening here, and why it is that I'm kind of largely continuing to hold these, even though most of them are kind of at pretty highs, as you can see here, like Equinox. Orla has been kind of trailing a little bit for the last few months, but they've still pretty up for the last year or two. And the new gold, as we saw, was pretty much at all-time highs. And Silver Corp is also pretty high, but is a little bit more zigzaggy. But as I said, this one's a lot more silver focused, so it's a little bit different. And we can and the four together too. Yeah, so you can see is like there's definitely some of them have been doing better than others in the short term to kind of medium term. The last really since the beginning of the year. Here's actually year to date essentially. So you can see for example that Silver Corp is definitely a little bit more of a laggard relative to the other gold miners that have done particularly well, but that has to do partially with them being silver, as I've said. Just a little bit of a different dynamic there. And then Equinox has been a particular laggard, even though they're primarily gold until recently. And so you can see with their earnings reaction, they've done extraordinarily well, and allowing them to at least catch up to Silver Corp, but they still haven't caught up to Equinox. Not Equinox, that is Equinox, Orla and New Gold. Orla and New Gold, and partially what I would say is a big part of the difference here is that Orla and New Gold have had extraordinarily strong growth year over year on the current trailing 12 months. And Equinox has done well, but they have had a little bit more struggles on the year over year basis. And really, it's more like their next 12 months that I would say is really where things are going to start to look really good for them. But coming in here, you can see like on a year over year basis for the gold production, we have 11%, 20%, 14%, 37%. So you can see it's in some ways sort of accelerating. And this is year over year basis on a quarterly. So it's from the same quarter last year, as you can see right here. I don't have charts uh, for the spreadsheet like I did with some of the other ones. But in silver production, 4%, 16%, 42%, 6%. And you can see like kind of the lumpiness and reminding you that most of the silver production does come from Silver Corp. So that can kind of explain like why there's spike ups and a little bit more of a spike downs, because there's a little bit less consistent on the very, very strong revenue growth in that year over year basis. Relative to this is at least always double digits, but here there's been some single digit ones, and then just bam, a 42% there in the middle, a little bit more volatile. Then copper, -5%, 21%, 2%, -1%. So you see copper also had a little bit more of a lumpiness to its actual growth. And also it comes down to a little bit more of expectations about the future. I like having the extra copper exposure, but that's definitely a totally different dynamic in terms of like the industrial applications and the supply and demand dynamics. And so I like having a little bit of it in there, but it's definitely much more about the precious metal aspect for me. Like I said, and really on a valuated basis, this is much more about the gold. Like a I did like a percentage calculation at some point in here, but uh, it's like 80% gold or 85% gold or something in terms of like the value weighted basis of this production. It's like I'm listing off, and you can see like 13.5 million pounds of copper, 1.8 million ounces of silver, 300,000 ounces of gold. It's a way smaller number. But that's because the value of gold is just way, way higher than silver or copper. So that's just how it works. But anyway, the actual revenues for the companies on that rolling basis, as I said before,
41% in Q3 of 2024, 64% in Q4 of 2024, 60% in Q1 of 2025, 76% in Q1 of 2025. So you can see the revenue growth is accelerating. The revenue growth is accelerating in these mining companies on an aggregated basis. Now, like I said, if you look at any one of these mining companies on any one quarter, it's going to be a little lumpy. But on my mining company portfolio, on the whole, everything's looking very, very good. And it's not to say I'm not paying attention to what's going on the individual basis. Like I said, this aggregated sheet over here is put together of the four separate sheets. So I could go through and kind of explain the nitty gritty of little things like slowdowns in this mine or that mine. And like I do actually have some notes here to comment on that. Like I did listen to all their earnings calls and pay attention to that. I'm also looking through their releases and the expectations on that. So like there's plenty of things kind of within that. New Gold is maintaining their production guidance, projects 1.8 billion in free cash flow over the next 3 years, which is like an insane acceleration in the free cash flow, by the way, based on their consensus price of $16.50 per ounce, which of course gold prices are currently trading at almost twice that, which means that they're projecting massive increase in free cash flow. This is New Gold we're talking about. Massive increase in free cash flow relative to the last few years. Like for example, in Q2 was 167 million free cash flow. So over the trailing, or my bad, 63, 167 on the trailing 12 months. My bad, 167 million in free cash flow trailing on the 12 months as of Q2, and they're saying that they're going to get 1.8 billion over the next 3 years, which is 600 million per year on average, which would be like over three, almost four times as much as what they've had right here. That's what they're projecting, and that's also based off of gold prices that are like 50% of the actual current gold price. Now, there's uh, extra royalty costs and other assumptions that go into that if some of those things are achieved. So it's potential that like that doubling on the price doesn't necessarily get fully achieved within there. But still, nonetheless, that just gives you a sense of the type of free cash flow that New Gold in particular is expecting. So like that's just like some of the details from them in particular. Silver Corp expects production shortfalls in the coming quarter of 20 to 25% due to a safety incident that they reported that did result in one casualty. So not a great quarter for Silver Corp. As I mentioned before, they've had a little bit more of lumpiness within their productions, but they do have uh, some dangerous mines that they operate. They gave indications that the El Domo ramp up, which is their new gold mines that they're working on in Central America, is on target going into 2026. They also made comments indicating that they intend to use their cash to diversify further, so potentially more acquisitions coming in the future, or maybe just further injections into some of um, their other related companies that they have investments in already. That could be an option as well. Orla revised its production guide down by about 5% due to a material movement event at Camino Rojo. No injuries or operational damages, just a temporary suspension. This also resulted in an upward revision in expected AISC, which is all in sustaining costs per ounce. Lays out expectations to publish notice of intent for their Southern Railroad incoming weeks, which is a upcoming project they've been working on in that's Utah, I believe, if I remember correctly. Sometimes I get the locations a little screwy in my head with the names. It's hard to keep them all straight sometimes. But yeah, pretty sure that's Utah. Expecting to begin gold production in early 2028. So that's early signs and news on a project far out in the future. But the production pipeline is very, very important in mining. So good to hear stuff on that. And that's one of the ones that had a lot of the growth in the year-over-year basis. So it's good because it means that they're probably gonna have a bit of a lull here in their production growth in like 2027. But then they'll start to get to some new production in 2028. Equinox, the fourth of them, iterates their intentions to achieve net cash position from their leverage position currently by 2027, with potential for dividends or buybacks before that as well. CEO introduced the new COO Dave Schumer, mentioning how they work together at New Monte Calabri. So good experience for the new incoming COO. This is a company that has had some production issues in the last couple of quarters. They have a little bit of the higher all-in sustaining cost. So that's one of the other things that's been kind of weighing them down relative to the others. That they are one of the ones that has a little bit of a higher cost per ounce on their current production level, but that's an operational leverage thing. So like as gold prices go up, it means that they were basically like the last of the companies to achieve a net profitability per ounce. Whereas the other ones were profitable sooner. Like New Gold has a much lower all-in sustaining cost. Orla has a much lower all-in sustaining cost. So Equinox had to kind of wait to reach that operational hurdle, and they've achieved it a little bit more recently. They're also expecting to be able to decrease those costs on a going forward basis. So anyway, coming back to those aggregated numbers here, I was saying those year over year revenue numbers are just insane. Like you would assume that this was like an AI data center play, right? With quarterly year over year numbers of 41%, 64%, 60%, 76%. I mean, we don't have to look at it on that way. We can look at it on the sequential basis too. Just quarter to quarter, just from one quarter to the next, not on a year over year basis. 10%, 15%, 10%, 15%. That's revenue. That's insane. The gold production, 3%, 5%, 3%, 8%. So increasing their gold production each quarter by on a quarterly compounded average basis, 4.7%. So each quarter they're increasing their production on the four of them combined together by about 4.5%. Silver production by about 3.5%. Copper production by about 1%. And revenue that ends up coming up, well, like I said, about 12.5% for the last 5 to 6 quarters on a quarterly basis. That's 12.5% each quarter sequentially. And then also, I do have their expected revenues based off of the analyst estimates here for the next year on an aggregated basis as well, which implies 48% growth on the year over year. This is the year over year basis, so I have it down here by the sequentials. But again, that's comparing to these that number I said before: 41%, 64%, 60%, 76%. And analysts are saying that 4 quarters from now, the year over year number will be about 48%. So, not 76%. It's a drop down from the 76%, but it's still at least in line with this just insane strong run of the revenue growth, which a lot of that is gold price for the record. Again, like we're expecting production increases here of, about 1 to 5%, depending on what metal we're talking about. On like a metal weighted basis, it'd probably be like 3 to 4% or so. So we are expecting to increase production by about like 3 to 4%, but that 48% increase in revenue is really on the back of revenue of gold prices, and a lot of it is previous gold increase. So that's not them saying that they expect gold prices to go up a ton over the next 12 months. That's saying that the trailing revenues are based off of a weighted average of gold prices that is significantly lower than the current gold price. It's based off of these gold prices down here, not these gold prices up here. That's basically what we're talking about. So obviously gold prices could come down, and then those assumptions that, like I said, New Gold is making their assumptions over the next 3 years based on a gold price that's way down here. Like they're making their free cash flow assumptions based on a number that's way down here. New Gold is, and a lot of gold companies do that kind of thing. And it's like, well, hey, maybe over the next 3 years, this is what's going to happen. That's possible. That's very possible. I think it's very possible that something like this happens. Like it goes down a decent bit, down to like a 30 to 40% kind of move, maybe. But I don't expect it to go down 50% or more, particularly. I find that to be particularly unlikely. Could happen, but I don't think it's very likely. I think it's more likely that gold doubles again from its current price, then it goes down 50%, personally. And I still think it's more likely that it doubles eventually. It's just that I could see it going down 30% and then tripling from there, which would be like a double from here. That's the dynamic that I expect with gold prices. So anyway, it's like like I said, looking at it on this aggregated basis, I think helps. But going down the line, like I said, that's the 48% expected revenue growth. But they also give us the GAAP EPS, which I aggregated them on a market cap basis, and to try to get to equal out the differences in their share counts to get down to what an approximated EPS growth would sort of look like. Now, unfortunately, here they're using GAAP EPS, and the GAAP EPS for the last 12 months is insane. So looking at it, it technically gives a number of like 900%, but that doesn't really make sense because it has to do with like negative EPS rollovers from the previous quarter. So I did try to do sort of a normalization effect in there, and I came up with about 55 to 56%, which is a little bit more consistent with the 48% revenue growth I was expecting. So in that sense, 48% analysts expected revenue growth over the next 12 months, weighted across my 4 mining companies, and a normalizationing across EPS assumptions that I did gave me about a 55, 56% increase as well. So I don't know what the weighted multiple that these companies are trading at is, but I don't think it's extraordinarily high. In an absolute sense, it might be a little high for mining companies. I'm not sure even. Like I said, I'm not actually even sure really 100% off the top of my head what their kind of weighted uh, multiple that they're trading at would be right now. I wish I kind of had checked that now that I got it. But let me at least find out what the currently are. So for new golds, see Ford PE 7.4, Silver Corp Ford PE is 11.8, Orla's Ford PE is 11.2, Equinox's 9.6. Okay, so actually those are all lower than I thought maybe was the case for some of them. Like I thought at least maybe two of them were more solidly in the teens potentially. Uh, but okay, cool. So actually, yeah, no. In that sense, yeah. So therefore, yes, this expected EPS growth. I mean, I don't see why that couldn't be share price growth too. That's basically where I was going with this. It's like depending on what multiple they're already trading at, you could assume that that EPS growth would naturally flow through to share price growth as well, right? So I don't know. We'll see. We'll see. Looking at the actual valuations within those four companies, I don't necessarily have that kind of expectation. Like I said, I don't know what it is on a weighted basis, but I have I have like expectations between them being somewhere between fair price to like 50 to 60% upside between all four of them, right? So I don't know. On a weighted basis, it might be like 20 to 30% of upside is sort of what I had on my valuation. But I also do need to do updates to that. I've been changing my evaluation template as well, and I haven't really shifted my evaluation template to work well with mining companies yet. So I need to make changes on that front. So anyway, that's my thoughts on mining. Golden, it's been looking golden for the last year. It continues to look golden. If you don't have any gold exposure, the best time to have gotten gold exposure was a year ago, but the second best time to get gold exposure is now. I know it's difficult to look at a price that's gone up like this and be like, oh my gosh, I don't have any. But hey, I've been telling you for like 3 to 4 years that you should probably have gold exposure. So I don't know what to tell you. I don't know what to tell you. If you don't have any, you didn't listen to me at that point. So, but gold miners is its own thing. I don't necessarily say that gold miners and gold are the same type of exposure. When I say you should have gold exposure, I say it on sort of like a diversification and uncorrelated with your portfolio during certain types of environments sort of sense. But admittedly, gold miners is an operational leverage play on expectations of the gold price, which has more to do with actual valuation rather than correlations in a portfolio, right? So, but nonetheless, gold miners, while they've done well with gold over the last few years or so, they are still way underpriced relative to the current gold price. Because as I was saying earlier, a lot of them are priced with that kind of assumption that the gold price is going to drop down by like 50% over the next short term period or something like that, which is like, hey, maybe that happens, maybe that really does happen, but um trying to like here's like the last 5 years. Here's kind of like from the previous peak point. You can see is like they've only now been starting to catch back up with gold over that kind of time frame. Index them together. Like here, they're always at the same start point. See that they've sort of now started to catch back up over the last kind of like 5 year period. Over a 1 year period, they're starting to sort of outperform gold. For a sort of a 3 year period, they're still underperforming a bit. Uh, kind of depends on where you're drawing the starting point is, but on a price basis, miners have been sort of underperforming. All right, so let's move on from gold miners. Enough with gold miners. We can talk about next on the list. How long have we been going? 48 minutes. Okay, so we're doing pretty good. Um, Sort of maybe wish I got a little bit quicker through that, but not too terrible. Now we're gonna talk about Generac. Good old Generac. Um, where did I want to start? So Generac had a really good earnings. Well, Generac had a really good earnings, in my opinion. It had an excellent reaction, which you'll see in the gold in the stock price, but it was a fantastic earnings, in my opinion, from a future opportunity perspective. Like the numbers in the quarter were one thing, but the really exciting thing about Generac this quarter was actually the earnings call. I mean, there's some details here in the deck, as you'll see, that is relative to that, but they fleshed out a lot more of those details in the earnings call as well. They basically expanded their TAM a bit in this quarter. Or even I wouldn't even say it's necessarily that they expanded their TAM, because technically this is all opportunity that they've been talking about for quite some time, but they really showed up with some numbers, some concrete numbers to back up some of that opportunity here in the quarter, and it really got the market excited, me excited as well. So it's one of those things where it's like, saw the reaction of the stock. I was like, oh wow, that's interesting. I looked at the numbers. I was like, okay, the numbers look good, but interesting. I wonder what's up with that. The reaction is something else. And then went and listened to the call, and I was like, oh, oh, okay, I understand the reaction now. I was like, wow, wow, what a call! Like, very, very impressive call. Like I said, there tons of great solid answers, very very meaty answers with real details in them, to very very interesting opportunity related stuff. So here, first looking kind of at their product overview. Obviously, Generac is split between the residential products and their CNI products. They also have their other products as well. Primary residentially being their home standby generator, that being their kind of main workhorse within their business, but also portable generators, smart thermostats, the Ecobee system stuff, other chore products like lawnmowers, and other residential energy products like Power Cell. And then they also have their CNI generators as well, trying to been breaking into that. And a lot of my modeling, go back and watch my video, which I still stand by, and I still like a lot of that opportunity. I still think is really, really great. I reiterated that I think even a few months ago when they were kind of at their lows, a little bit there, that their standby opportunity I still think is really really great, especially if you're kind of focusing on the thesis around the weakness of the power grid here in the United States, and the outage hours per customer metric, which is extraordinarily correlated with Generac's year over year revenue growth rate. Extraordinarily, like it's fascinating of a metric to see. So a lot of my focus in my modeling for this company in the time that I've owned it has really been focused on this primary section of their business. And I really kind of just treated this as the secondary portion of their business. And I just kind of assumed that it would probably maintain a certain percentage of sales relative to this, but I didn't have like very, very specific modeling for it. I just kind of was like, yeah, 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 that stuff's great. But they don't really give me enough details to really model it out. But here in this quarter, that's where they really, really gave us some stuff to latch on to here. And I know a lot of other analysts have definitely been focusing on that stuff, but still, even so, it's just focusing on like the technical details of a lot of these products. It's not necessarily giving you like ideas of like the market potential and the who's buying versus not buying, and like I said, the actual an actual kind of pipeline to that potential. So a few months ago, they actually even had released a new product related to this segment. And I remember seeing this post about it. And I was like, oh, that's pretty cool. That's interesting. They're kind of hopping on the bandwagon of what's kind of hot in the markets lately, which is to say that they're building generators now specifically for the data center market. See here their special uh, introduction of their new five new generators ranging from 2.25 megawatts to 3.25 megawatt generators. You can see here all the technical specs related to that. But point is breaking into the data center space. And I was like, okay, that's cool. But again, it's just one of those things where they put a little release out for the new products, but that's nice. But that doesn't give me any details about who's going to buy it or who could buy it, how many people there could theoretically be that might want it. Nothing quite like that. But then we got it some of that stuff. Very very strong details on that here in this quarter. So giving some just the details from the quarter itself. 6% year over year quarterly revenue, 7% in residential, and 5% in CNI. So CNI in this quarter was actually technically a little bit weaker relative to the residential, which is actually in a sense good because residential has kind of been a little bit languishing for the last few quarters, and so we kind of do want to see a little bit more bringing back to livelihood for the residential. CNI is only about a third of their business currently, so it's still the smaller portion of it. We want that to grow, but again, they're giving us the signs that there's going to be strong growth here in the near future. So the trailing 12 months, I do kind of worry a little bit more about the residential in the short term. Stronger categories that they mentioned being portable residential generators, which is like you hear the smaller generators for the residential segment. Also, they said that the European shipments were a bit stronger, and then other CNI products, which is kind of like the controller products with here, not the larger generator products, as well as this kind of other segment right here. Those products were a little bit on the weaker side, they said, within this quarter. They narrowed their previous revenue guidance range, giving a little bit more certainty within that bandwidth. So in the previous quarter, they had given a guidance range, but for the revenue growth, but it was decently wide. And here they technically kept the midpoint the same, but they kind of narrowed the range, which means that they've decided that they have a little bit more certainty surrounding the effects of tariffs. In fact, I'm pretty sure they have uh slide here where they show the specifics. Yeah, here. So the consolidated net sales that they have currently for the year, a revenue between 2 to 5%. I'm pretty sure previously it was like 0 to 7%. So you can see technically the midpoint is still about the same. They just shaved off 2 percentage points from the kind of extreme endpoints here. And then adjusted EBITDA margins, I think that they technically raised it by 1 percentage point. I think it was 17 to 19%. And now it's 18 to 19%. And then the gap effective tax rate, I can't remember if that one changed or not. And then free cash flow conversion 90 to 100%. I'm pretty sure that was also about the same. It might have been 80 to 100% previously, but give or take about the same. But here, there's some where those specific changes came from. Their previous guidance did actually include relatively specific tariff revenue, and then now that they've said that the current guidance is based off of the current stated tariff level, meaning China tariff rate of 30%, Vietnam 20%, 10%, all other countries, USMCA qualifications continuing, and then also the additional 50% on top of steel and tariff input products tariffs. So basically, that's what they're saying is that they feel confident with this guide with those assumptions. And to be honest, this is probably a potential cap level. Like for these ones, it potentially, I would say, could maybe even go down a little bit from here relative to that, based off of what's been happening with kind of like the global effects of tariffs broadly. That's my own assumption, but we'll see what actually plays out with that. But either way, so the point is, I do think this is pretty solid guidance within the the, the space here, and obviously them narrowing their guidance range shows that they themselves feel a lot more certain about it. So coming back here, I'll go to my notes. Now they also included some details about the distribution dealer network. It said it grew by 400 year over year, about 4.5%, or sequentially about 100 in growth of the total distribution dealers, which is 1.1%. It's good to see that in the last like 3 to 4 quarters or so, they've started like actually giving details on the specific numbers of the distribution, which is something I've been really kind of wanting to look into because they mentioned it a lot over the last like year and a half as they were going through a lot of their revenue declines. Basically, they were talking about how that comes down to the fact that they themselves don't sell to a lot of customers directly. They themselves sell to dealers who then sell their products, which means that based off of the inventory levels of those dealers, that can really affect kind of the bullwhipping of their revenue growth rates over time. And so they've slightly, like I said, over the last like 3 quarters or so, started to give a little bit of specific information in terms of the numbers from those dealers. And so that's one thing that I'm definitely going to be trying to look into over the next few months. Is I'm going to try to like do a little bit more like scuttlebutt fundamental research on that distribution network and see if I can sort of uncover maybe larger players and sort of like get an idea of like where inventories are going over the short to medium term, rather than just relying on them kind of reporting that here. Because like, I think they may not even have the slide anymore, but there was a slide in this deck that they rolled out every so often where they would even show, it was like a chart that showed the a line chart decline of the inventories of the dealers, but it didn't actually say what the numbers were. And it was like, okay, well, where'd you get that information from? I don't think it's in this one. I think it was in previous months of it. But the point is, it was like hinting at some data out there, but it wasn't actually giving the data, so it wasn't very helpful, which is not helpful. So anyway, getting back to kind of the data center opportunity here, which now they actually have some slide about that they've included in here. Mm. Yeah, so here they're talking about they've said that they've had a very strong reception to their entry into the data center market. Global backlog now over 150 million, 150 million for a product that they just released like 4 or 5 months ago or something like that. The CEO refers to it as, I quote, one of the biggest needle moving opportunities that I've seen in 3 decades with the company. Estimates structural deficit relative to current data center construction to be about 5,000 machines. 5,000 of these machines, give or take, or not necessarily these ones, but ones like it, or at least models somewhat, maybe a little bit smaller. But when asked to clarify that the backlog comes from more from hyperscaler data centers than from traditional, he said that most of the deficit is there. So he implied that there is a significant amount of the deficit that's not necessarily hyperscaler data centers, but a lot of the kind of short term increase in that demand was is coming from those hyperscalers in particular. Conversations he said with other companies they're having not just about the growth in 2026, but also in 2027, 28, and 2029. Um, he said also that because then he also made comments that they were probably going to have to think very very carefully about expanding their production capacity to be able to meet this demand, which is very very interesting to think about. And was they were asked somebody asked very specifically about the capex for that relative to their current capacity, and he said that they currently have capacity for their current backlog in 2026, so they essentially have enough capacity to fill out this 150 million that they currently have here, to go into that further demand that they're already having talks about for 2027, 2028, and 2029, he's saying that they don't have enough capacity for that, and so they would have to make and I quote bold bets on additional capacity. So maybe that means new plants, maybe that means maybe even an acquisition. I don't know, but even an analyst in there, I think, even made a comment saying something like doubling or tripling your capacity, and I'm pretty sure he didn't really react to the comment, but he didn't shoot it down either. You know, it's one of those things where it's like he didn't really like say no to that like in his response immediately afterwards, but he kind of just like let that slide from an analyst who said, "Oh, you might have to double or triple your capacity based off of the what you're saying here," and he kind of just roll through it, which you know I don't know about doubling, tripling, like even a 25% to 50% increase in capacity would be a significant amount of capex because they currently do I think it's like 3% of their sales, like 3 to 4% of their sales is capex or something like that. So they would have to do a significant amount of capex to do it. But the point is, you wouldn't do that unless you believe you're going to have a huge amount of revenue growth. Very very exciting, very interesting. Here they're showing the global data center power demand expectations according to Cushman and Wakefield, which is the major, uh, generally pretty reliable analyst in my opinion, in terms of the total gigawatt data center capacity that is needing. They're showing that from 2025 we're going to get like a tripling between here and 2030. And then based off of the kind of the numbers that they gave, they like them talking about the 150 million, the backlog, the 5,000 machines, and the deficit that they're talking about. I actually did try to kind of do some relatively simplistic number crunching to be like, okay, well, what does this turn into? And this is some really rudimentary math I put together, and I would like to really kind of put together a more thorough model for it. And I'm not going to really go through all the details of it, but I kind of the implications I was getting was that if they were able to get what was it? I think I had uh they were able to get. I'm going to quote this right. This is for non-hyper. Yeah. So if they could get like 20% market share in the hyperscaler space, like a 10% market share in the non-hyper scalar space, keep in mind that they have like a 65% market share in the home standby generator space currently. And they have like a I believe it's like a 12% market share in the CNI generator space broadly or something like that. So that we're talking about maybe similar comparable levels of CNI market share with potentially a little bit higher in the hyperscaler area, which they're kind of implying a lot of their current demand is coming from. And also that's a smaller amount of companies. So in a sense, it's potentially easier to lock down with a more recognizable brand. So that's why I assume they could potentially get that higher percentage there. But anyway, if you assume that, if you assume that they could get that kind of market share of this demand that they're talking about based off of their current cost levels, relative to that, it to me looks like it would basically create about another 5 to 10% of revenue for Generac relative to the revenue growth I was already assuming they would get between here and 2030. So like I already assumed that they were going to get a certain amount of revenue between here and 2030, but then on top of that, add 5 to 10% more. And also, like, keep in mind, it's adding 5 to 10% more, but you're also getting it within that first 5 years because that's also one of the things about the Generac valuation. I'll say that I've always had to kind of like say is like I've been trying to be very cautious about if or when I sell Generac because a lot of my assumptions about their revenue growth potential I think are very conservative. Like they really do have, and I was saying that about the home standby generator space because I was looking at the home penetration rates of generators in general in that space and it being relatively low. And it's sort of a similar situation here where it's like the penetration for data centers isn't necessarily low. That's not really the same way to think about that metric, but the that space is growing at such a rapid pace that Generac really only has to achieve a certain type of market share for them to get a pretty significant boost in that revenue growth. And again, it's really kind of like pulling that revenue growth up front. So that's the thing that makes a big difference on it. And my valuation for them tends to be very sensitive to that revenue growth rate. So by pulling forward 5 to 10% more revenue 5 years earlier, essentially, it actually makes a pretty decent boost to their valuation. Because I think like coming over to their chart, when they were at their lows here in like March and April, and I was definitely trying to pound the table a little bit and remind people that it existed when it was coming down here. I was like, guys, it's basically down to similar prices as I was originally picking it up for, only a little bit higher than that, really. And I was like, it's gonna bounce back. It's definitely gonna bounce back, and it definitely did. Um, I even when it was down here, I'm pretty sure I was saying my fair value was around 175. I'm pretty sure that was kind of what I was quoting here. Hold on, indexing. I was saying it was worth like 175 or so, and it was at like 110, 120 or so. And then now it's at 190. So I will say like I have rerun numbers a little bit, and my new fair value is around 190 to 100 to 200 or so, depending on the assumptions you put in a little bit. So I do think it is still about fair value-ish right now. It's not that I think that the stock's super cheap or anything, but I do think that this changes the story pretty dramatically for the company. Like this makes them an AI play, right? Like think about it for a minute. Like Generac, I mean, like I said, they were already talking about this stuff for years, but they had never really quantified it. It was never something that was like really gonna show up in the numbers yet. But now it really is. It's like by by the end of this year into Q1, Q2 next year, they will literally be receiving revenues from AI data centers. Like well, I mean, AI data center build, I should say. And so that's pretty awesome. They basically became an AI play, a picks and shovels AI play. Obviously, it's a little bit of a sneaky one, but I think that in some ways pushes the play here. And I bring that up because I mean, hey, if all these other stocks get to trade at all these high multiples because of that supposed baked in demand because of data center build, blah 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 blah, right? Well, why not Generac as well? So that's kind of my thoughts on that. I did trim them a little bit, a very very small amount, when it popped up. So I trimmed like 10% of my position approximately. I think it was, give or take. So I did trim a little bit, but even that I was like, oh man, am I gonna regret this? But it was partially because it was just becoming too much of a allocation in my portfolio. So it wasn't even really about the valuation. Like yes, the valuation isn't particularly cheap, but in my opinion, the story is just amazing. It's just amazing. The power grid weakness, the storm severity, the penetration rates of the home standby generators, the strong market share and brand recognition within the consumer space, the the expansion into the CNI products that has now transformed into expansion into AI data centers that they've now turned into a quantified backlog that is growing rapidly. Yeah, no, it's just so good. Every detail of the story is just so good. Oh, and also there was a couple other details that they had mentioned. They've kind of started mentioning it a little bit more in the last couple quarters, but they had mentioned a few more details here in this call. They mentioned that Ecobee, the climate control, the thermostats that they have, the Ecobee reached 4.5 million households this quarter. That's 4.5 million households in the United States that have an Ecobee product, and it also reached positive first half EBITDA contribution for this for the first time as well, and it's expecting full year positive EBITDA contribution as well. So that's a loss leader that Generac has had since they acquired it in 2021, I believe it was when they acquired it. So it's been a little bit of a loss leader, and it's starting to grow, and that's going to build into the whole idea of building that brand recognition, creating a little bit of connections for between like the apps of the controls of their generators for the thermostat controls. Uh, it's all a very very good network. I remember like I'm not particularly a huge person that is super super bullish on a lot of green tech stuff. Like I think I think certain green tech stuff is fantastic, but I don't believe in pushing for green tech for the sake of green. I think I'm believing in pushing different types of energy technology based on them being the most efficient and best option based off of whatever the application is. So if solar technology is the best application for whatever you're trying to do, then go solar. But I don't believe in going solar just to go solar per se and things like that. So like when they were making these their claims that they were going to be able to make a very strong kind of integrated system for all these products. I definitely had some skepticism there, but I also did see some potential there. Like in my mind, I was like, the logic makes sense there. It's just one of those things where it's like, are you doing this on kind of uh, an idealistic kind of mission statement sort of way, or is this like an actual strong business model sense? But the Ecobee, as I was just saying, the Ecobee product in particular is now reaching positive first half contribution. And I did kind of I didn't make I didn't put the numbers into a spreadsheet yet, but I was kind of trying to make some napkin math in my head about what that could mean for Ecobee as well. I was like, okay, 4.5 million per household. How many are they adding per year, year over year? And then I went and looked. I was like, what's the average Ecobee product? How much do they cost? And I was saying, I was like, yeah, this could also create an extra 1 to 2% of revenue growth over the next 5 years potentially as well. Like maybe like, and I in that case I meant like 1% per year. Like I could see like an extra 1 to 2% per year over a short to medium term time frame as well, potentially coming from an Ecobee expansion as well. And then like I said, they're saying that it comes from a positive EBITDA contribution on that level as well. So interesting stuff. Very, very interesting. Uh, the story for Generac is amazing. Their spread of products is fantastic, and the story is just getting better. Like I said, like I was so much more focused on just the 2/3 of their business. In my opinion, that 1/3, it was just like, that 1/3 is nice, but I don't have like a strong story for it. But now they've made that story almost better. And I didn't comment the specific quote from him, but I'm pretty sure in that call he specifically stated that he thought the C&I portion of their business could easily become bigger than uh, the residential portion of their business in the future as well. So yeah, very, 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 very good stuff. All right. So last but not least, last but not least, let's talk about FG. Let's talk about FG. We'll have Generac here, obviously, but first, first let's look at the annuity sales figures. Uh, Coming from Limra. You can go to the Limra Fact Tank website where they post this stuff on a quarterly basis. They release preliminary and then final estimates of the annuity sales estimates. You can see like here by category, and then also at various points in the quarter they release um, a ranking list of like the top market share companies, and then the kind of like everybody else in like an aggregated sense as well. So we're still waiting on some of those numbers. I would love to see the market share numbers here. Probably, I think they release those within like next month or so. But this was the part that I was waiting for, and they released this stuff before FG's earnings actually came out, and then FG's earnings came out like a week and a half later or something like that. And I'm pretty sure I commented on it in Discord. I made some comments on this. But decent quarter overall for the annuity space. I would say like broadly overall, you can see here the annuities the total US annuities Q2 2025 against Q2 2024, 5% growth is what we had. So pretty good on that front. And then year to date, 2024 versus 2025 has been 3%. So that means that Q2 was a little bit stronger than Q1, is basically kind of the implied assumption you can have there. And then within that, we have obviously the broad categories of total variable and total fixed. So with total variable, it was 8% in Q2 and 12% year to date, meaning that Q1 was actually a little bit stronger for the variable category than for Q2. And then total fixed was 4% in Q2 and -1 year to date, which means it's Q2 that was stronger, which makes sense because these two together equals this. So if Q2 is stronger overall and Q1 was stronger for variable, obviously that means Q2 must have been the stronger one for fixed. And also fixed is a bigger category. As you can see here, the actual numbers here, fixed makes up like 75% of all the annuities. Variable only makes up like 20 to 25% of it. So it's just a smaller category overall, which is why even though there's a big swing there, it's still leaned into the second quarter more broadly. So within that, traditional variable was particularly weaker in the second quarter, and then registered index link, which is a much smaller and newer growing up and coming category. As you can see, very very strong, 20% year over year in the Q2, and year over year all in the year to date also 20%. So very very strong. Uh, FG does sell registered index link. That's what they call the RILA category. They do sell this category. They don't really sell a ton of variable, but they do sell the registered index linked variable in particular. And then they do sell a lot of subcategories within the fix. Specifically, they sell the index fix, fixed immediate, and then also technically a variant of fixed rate deferreds as well. So that's really kind of the subcategories that FG's in, which is therefore like mostly in the fix, but they're also within kind of subcategories of fix that are different from the traditional fix. So like fixed immediate and deferred income are kind of like the more traditional versions of it, but they've kind of branched off into subcategory other types. But within that though, index you can see flat 0% relative to the same quarter last year and down 1% on the year to date. So index has been weak, which is partially why FG has had a little bit of a rough year in the stock price here. So look at that. Year to date, see, yeah, pretty weak. It was starting to get weak prior to even the Liberation Day tariff announcements, which was here, obviously. So obviously most of its decline happened prior to that, which happened on the back of them choosing to dilute the stock and having some changeovers in their operations a little bit here. And then obviously they had weak earnings reactions here, which just comes off of the back of those Q1 numbers, as I was just talking about. So like this earnings reaction is on the back of that weaker first half, which we're starting to get a little bit of a turn here in the second quarter, but it's not necessarily in the index category. It does have to do somewhat with the other category. So fixed rate deferreds, which like I said is technically a subcategory that they also are somewhat involved in. You can see here had a stronger Q2, and that is partially where FG's bounced back in because they did shift their product mix a little bit, which I'll get into here shortly. So that's kind of the broad overview from like the industry kind of top down level. Getting into some of the specifics with them. Let's go over to spreadsheet where I had the mining stuff. I also put together kind of a rolling basis for the last 2.5 years for each quarter of all the quarterly numbers for FG. Because I have like spreadsheets previously that I put together with all these numbers for the on a yearly basis, but I've never really tracked it that closely on a quarterly basis. But I figured, I'm going to start paying more close attention to the every single quarter for all of my companies and the very individualized quarterly numbers because of, frankly I'm just a lot more concentrated into those companies now. So pay much finer attention. But I also wanted to make some charts of it so I could kind of explain some of these things to you guys a little bit. So here up at the top we have their the revenue. These are the categories of the revenue. They have the premiums and other annuity revenues that they get directly, and then also interest and dividend income. And then we have the kind of year over year number for that, and then the yield on the assets under management (AUMs) here, and then also gain and loss from investments and other. Gain and loss from investments, I largely kind of assume balance out to zero over time, and then other. I used to not really think too much of the other category, but technically they've been expanding their own portion of the annuity distribution networks, which gives them another category that really actually starts to hold a little bit more going forward. So this will start to be kind of its own category and its own thing. A very small portion of the revenue, only going to be like 5% of the revenue, but it's still going to be like its own thing that doesn't balance out to zero per se. But anyway, policy benefits is kind of like a major category of their costs, and then other operating costs that we have that kind of gets us to their operating incomes, and then tax and other, which includes preferred dividends that they have. So it's tax and preferred dividends. I'm not really looking at it on an individualized basis, but then it gets us down to net income to common. So here, just kind of a brief overview of their income statement. And then I have their diluted EPS. This is their GAAP diluted EPS. And then I also include their adjusted EPS here because I did want to kind of like show the difference between like, their GAAP metrics and their adjusted metrics that they report on pretty regularly because we had some comments from people who were talking about when these earnings came out in the Discord about their reported ROA numbers versus like our other ROE numbers. Somebody had commented, why is their ROA going down? And I had responded, I was like, well, kind of depends. It's like how are we calculating ROA? Because like the way they report it is one way, but there's like four ways you can kind of think about it. So I kind of wanted to show a little bit of that here today. So we'll get into that here in a little bit. But anyway, so that's like I said, the income statement, and then here I have the actual annuity sales. So these are their gross sales numbers, which kind of plays into their revenue growth over time. It's like the actual amount of sales that pass through them, but it doesn't turn into revenues in a super direct sense. But this is still like the best way to kind of think about the growth of their operations over time. And we have it on their total annuity basis, but then they also break it into subcategories of um, uh, universal individual life insurance, funding agreements, which is an institutional annuity sale, pension risk transfers, which is another category of institutional annuity sales, and then also they have in their own way of preparing the numbers in this particular quarter, they started referring to what they call their core sales versus their opportunistic sales, which for them is basically what they count as not including the funding agreements, because funding agreements are things that they usually do in larger transaction sizes, and they don't always do them. Like here, you can see that they have like 3 quarters here out of the how many quarters is this total? 10 quarters. So 3 out of 10 quarters where they literally did zero funding agreements, and then they had 2 out of those 10 where they did more funding agreements than basically other types of sales as well. So it's kind of an opportunistic one where sometimes they do a lot, sometimes they do a little. It's very lumpy. They also include their MIGA sales, which are multi-year guaranteed benefits, which are a category of the fixed rate deferred type of the fixed rate deferred type of annuity that they sell. But one, they don't really give the MIGA numbers on every single quarter, so I can't really actually track that and give you a core sales number that includes that specifically. And two, I actually think that it's you could kind of argue about whether MIGAs really count as an opportunistic one. I agree with how they argue that funding agreements are kind of like an opportunistic sales number, but in my opinion, MIGAs really are like they are a supplementary form of sales, but I don't think of them as opportunistic because it seems to me that they will always opt towards MIGAs if they are getting less FIA sales. It's not an maybe MIGA, maybe not. It's a yes MIGA if we're not getting enough FIA sales, no MIGA if we're getting tons of FIA sales. That's kind of how it works. So it's like in my opinion, if I'm going to measure their core sales, I was like, you know what? One, you're not giving me the MIGA number. Two, I actually sort of agree that you should almost maybe leave it in there. So anyway, the point is I included a core sales number here, which is they started talking about only in this most recent quarter, partially because I think they wanted to make the case for how they're turning the corner now, which I'll agree with them. I'll actually make the case for them that that's actually a reasonable way to show it, and I'll explain what I mean here soon. So anyway, that core sales is basically total annuities plus the individual universal life plus pension risk transfer. It's basically all of their sales, not counting the fundamental funding agreements. And that's their total gross sales. And then there's a certain portion of their sales that they then transfer to reinsurance agents, which then gives them a certain amount that they count as their retained sales. And that also gets them a difference between their retained assets under management versus their total gross assets under management. And what that does for them, because that's also relevant to some of the things that happen this quarter, is that basically like what they're doing is they're taking in deposits, right, from their customers, and those deposits give them contractual agreements to then return even more money in the future to their depositors. And in the short run, they get to make use of those deposits for their own investments and then be able to collect interest and dividend incomes from those investments, right? That's basically the nature of their business. But to do this, that means they would have to put those assets on their balance sheet, which is great because you're building up AUM, and building up AUM means that you're going to have a higher amount of interest and dividend income. But higher AUM also is the denominator in a return on asset number, right? So if you want your return on assets to inch up over time, you want the amount of earnings you're getting to be high relative to the size of your balance sheet. So basically, I'm explaining all this to say like they transfer significant portions of their sales to these reinsurers because it gives them the flexibility to basically decide on any individual sale, or do we want to hold these assets on our balance sheet, or do we just kind of want to shuffle these assets off to somebody else? And that gives them the ability to kind of like optimize the efficiency of their balance sheet over time. So it's important to kind of understand because here in the most recent quarter, they actually did open up a new reinsurance uh, relationship, specifically Blackstone. Blackstone Investments, which they have a very major relationship already. Who Blackstone manages about 80 to 85% of the assets under management for them in their annuity space currently. They themselves opened up a new sidecar for reinsurance under their own insurance wing, And then that company itself is now making significant commitments to FG, and this gives them another what was it? They said they currently have about 1.1 billion in commitments raised from this sidecar, which 1 billion relative to 50 billion in their current assets under management. So basically, that means that they basically have a green light to 2% increase in their assets under management that they previously otherwise would not be able to have had. 2% increase in their assets under management that doesn't create a further drag on their return on assets. So like it's a 2% accretive increase because 2% doesn't sound like it's a lot, but understand that it is a lot when you're essentially getting a big boost to your ROA for that. So very very good. This is I was actually liking it in the Discord. I was saying that this pairs very very well with the dilution event that they did several months ago. So they did dilute their stock way back here. That's part of the reason we saw this decline in the stock because they did dilute their shares, which increased their equity base. And a lot of the time, people were saying, well, why not just issue more debt? They're not even really that much levered. And I was like, well, in a sense, they're not levered because they don't have a lot of debt, as in contractual bonds that they have to pay to people. But they do have a massive amount of liabilities on their balance sheet because that's the nature of their business is building up liabilities on your balance sheet so that you can have a giant asset base. And then, but the problem with that, like I said, is that it weighs down your balance sheet. It makes it hard for you to generate a strong ROA and a strong ROE. So by diluting their shares, what they were able to do is make it so that they can speed up their revenue growth rate without weighing down their ROA and ROE over time at quite the same rate. Now that assumes that they're going to be able to speed up at a fast enough rate that it overcomes the dilution. But I have faith that they can do so. The only other way you could do this is by retaining earnings over time, because that's the other way you build up equity, or paying less dividends. But they already don't really pay out a massive amount of dividends. Like yes, they pay a dividend, but like the percentage of their their net income that is retained versus paid out over kind of like the long run so far of their public life, it's not a huge portion. So it's yeah, really it's the point is like it massively sped up their ability to increase their asset base. And then basically that what that did is that gave them flexibility on the bottom of their balance sheet, the liability and equity side of their balance sheet. That move gave them flexibility. And then this sidecar, the reinsurance sidecar that Blackstone has now come out with, that they're now have an agreement with, that gives them flexibility on the top of their balance sheet. So that's balance. That's what you want with a balance sheet. So to me, these moves are great. These are showing that they are making moves to try to speed up their revenue growth. That's basically what's happening here. And Blackstone is a strong, great partner with this. A lot of private equity has been very, very into the equity, into the insurance space broadly over the last 5 to 10 years, and annuities in particular being a popular category. What with, for example, Apollo's Athene, they literally have their wholly owned annuity internal entity, whereas Blackstone is more like making these outside external relationships with annuity companies like FG. And as I kind of went over previously, they actually make up a significant portion of Blackstone's business. So very very good stuff. I love seeing FG and Blackstone well tied together. I think that that's all it's all good. It's all great. Specifically, they gave some metrics on it. Their retained ratio for the first half of 2025 is 70%, relating that to the new reinsurance sidecar. And with that, they're expecting a larger FIA fixed index annuity mix in the second half, and total AUM before reinsurance up 13% year over year, and retained AUM up 7% year over year. So you can see like they're growing their AUMs 13% year over year, but they're only keeping about half of that growth because they're shuffling about half of it off to the reinsurance sidecar. And that retained ratio, I said it's about 70%. That's worth noting because that's actually lower than their kind of weighted overall level, which I'll get into here on the kind of numbers I have here on screen. But I actually have that chart literally right here. The retained ratio over time, you can see it used to be uh, around 90% 2.5 years ago, and it's been dripping down to currently about 79% as of the most recent quarter. That's 79% on the whole balance sheet. Whereas what they were saying is that it was about 70% for all of the sales made in the second quarter, which means that the 79% should be drifting down further over time. Yeah, coming back over to that, getting into kind of just like the specific numbers of their quarter. Core sales up 10% quarterly year over year, 22% sequentially, which is big boost up from the kind of weak quarter that we had in the first quarter there. Opportunistic sales down 21% year over year, up 73% sequentially, which we'll get into kind of that lumpiness in a bit. As I already mentioned, the MIGA and funding agreement sales are what they consider to be their opportunistic sales. Um, uh, Individual universal life up 20% year over year quarterly, and pension risk transfers up 33% year over year quarterly. And they also made an investment, or I bet they've also now listed how their total cumulative investment in the own distributions of about 700 million has turned into annualized revenue of about 78 to 92 million. I think it was about 23 million in revenue in the second quarter, which annualizes up to trailing 12 months of 357 million for the total other category. But just for the own distribution, it ends up being, like I said, about 75 to 100 million or so in annualized revenue for that. And that's against 700 million investment that they made. So that I actually did some math on this, because also the profitability is much higher within the own distribution relative to that, because the earnings that they get is basically dividends from the company, which means it's effectively a total return on that. So I kind of did some math on this, and I was basically saying, like, on an implied basis, if you were to look at the earnings that they get from their own distribution investments, that 700 million that they're getting currently gets them essentially like a 7 or 8 multiple on their investments in on an earnings yield basis. So they're getting like a teens percentage return. So like 14-15% or something like that is kind of the returns that they've been getting on those investments. Because I remember like 3 or 4 quarters ago, they had made some more like $100 or $200 million investment in the own distribution. In some quarters, some of the questions from the analysts was questioning that. I'm basically saying like, oh, are you basically like making them push a flow, or is this a situation where you're going to have to keep pushing money into the distribution network to basically create sales for yourself going forward? But no, it's actually showing a return on investment already. And like I said, that's really only going to be like 5% of the revenues. It's not going to be like a substantial portion of the revenues, but nonetheless, it is a diversifier. It is a fee-based revenue that doesn't have anything to do with interest rate spreads and annuity sales. So, well, it has to do with annuity sales, but it doesn't have to do with like the demand for annuities relative to the supply cost dynamics in particular. Um, okay, so getting into the charts that I have over here, though, because I do have all this data right here, kind of showing you similar to what I did with the mining companies. I wanted to show you kind of like on a quarterly basis how a lot of this stuff has been shifting over time. So here, the annuity sales, we can see is very, very lumpy on kind of like a year over year quarterly basis. 97%, negative 15%, negative 13%, 29%, negative 32%, 25%. And then I have the yield. The yield's very, very stable, generally speaking. We've been getting a little bit of an upward move in the yield on uh, assets under management, currently 5% on a quarterly annualized basis from that. But again, that's basically like the current quarterly revenues annualized times four, not the trailing level. If we were looking on the trailing level, it's still about 4.66%. So I still generally kind of assume that the yield's about 4.5%. That's really kind of, I'm not assuming that it's moving up that dramatically, but we have seen a little bit of an upward move in the last few quarters. But me, I'm not going to make broad assumptions about that lasting over the long run. But overall, very, very strong. The total revenues equally as lumpy as that kind of premium revenue, though, because that does generally make up the majority of it. The interest dividend income generally being a lot more stable. 81%, 1%, 77%, 19%, 41%, 14%. And then coming into this, that turns into the net income revenue being a little bit less lumpy in terms of like the revenue growth rate up on it, but lumpy at least in terms of the kind of up and downs of it for sure. 11%, 11%, 37%, 19, negative 19%, 7%, 17%, negative 1%, 17%. Oh, my bad. This is percent of the revenue. My bad. I thought, why did I think that was year over year? This is the margin. My apologies. I'm looking at the wrong line there. The margin. But here, even the quarterly margin, you can see very, very lumpy. Like in the most recent quarter, it's only a 3% net income margin for just that quarter. Again, not trailing 12 months, just that quarter. When there's also 17% in other quarters and 37% or negative 19%. So it's a little bit all over the place in terms of the gap profitability in any single individual quarter. On average, 8% across like the quarters that we have here, 9% at a median. So you see, like that's kind of where we're currently at. And really, ideally, we're hoping to kind of push that upward to 10% or higher over time, definitely. And again, that's kind of the broad one. Obviously, I'm not using the adjusted net income for that. That's just the GAAP net income. I do have the adjusted EPS, which you can see here is much more stable than the GAAP EPS. GAAP EPS is up and down pretty all over the place just as much as the net income. but the adjusted EPS on kind of year over year basis, that kind of like leveled out moderate basis, they have 76%, 75%, 27%, 87%, negative 16%, negative 30%. So here you can see kind of even just on that basis, like that would be pretty strong explanatory power for what happened with the stock right there, because this is the same quarter where we were getting those declines. It's like we were going from 87% of year over year adjusted EPS growth to then negative 16% to negative 30% for the next 2 quarters. So easily you can see why that would lead to this. But it is worth noting that negative 30% is here when we are already starting to turn the corner. So really it was, and it was starting to decline before that negative 16% had hit. So obviously it was more of a situation where people knew after this quarter that things were heading south in terms of that profitability metric, obviously. In terms of revenue, we did see that same similar decline, but that's where the core versus opportunistic sales really starts to come into play. So we'll come over here to these charts I have over here that will kind of explain exactly what I mean on that front. Where here we have the quarterly sales, gross sales, and net sales, not the revenues. These are the kind of sales figures of the actual annuities. Gross sales versus net sales, and the year over year basis of the gross sales and the year over year basis of the net sales. So you can see, like, yeah, coming from strong year over year levels to then declines, and it looks like we're still in decline. But then if you were to go specifically to the core sales number, where we're subtracting out the funding agreements, then it starts to look a little bit better. Where on a year over year basis, you can see we did jump back into positive territory in the most recent quarter from negative territory last quarter. And then I also have the sequentially quarter to quarter. So this is showing literally just from one quarter to the next. You can see that we did have a decline in that quarter there, but then the jump up is even more dramatic here. And again, that comes on the back of the funding agreement. So like here you can see from this quarter here, 4 quarters back, 1 quarter, 2 quarters, 3 quarters, 4 quarters, 4 quarters back, we were at a peak. The gross sales reached a peak here. And then here we're not quite at a peak level yet, but we did at least get back to, I think that's like the third or second highest, depending on which one of these is higher. Second highest. So it's the second highest quarter ever on gross sales, but it's not the highest, and that's partially because of this one quarter here that was high. But if you take out the funding agreements, you'll see 1, 2, 3, 4. That quarter is way lower over here, and in fact, now we're at a peak quarter in terms of the sales, the core sales number. So that's why they're trying to highlight this core sales number, because depending on how legitimate you find their argument for this actually being the core portion of their business, then you really could argue that yes, the core portion of their business really has actually now reached a peak quarterly number again here in this second quarter. Because again, we just had one really, really bad dip in the core sales number, which was last quarter. But really, the rest of the dip comes down to just having strong funding agreements back in the second quarter of 2024. And we can go and look at the actual numbers. You can see exactly what I mean. It's like here's the funding agreements, here's the gross number, here's that quarter, here's that peak number 4420, and here's the current quarter 4106. That's just not high enough to be there. And then over here you can see funding agreements in 4420 is 900 million. It was the peak funding agreement quarter there, 900 million. And then in fact there was 2 quarters of zero thereafter, and there was 500 million last quarter, and then there was zero this quarter. Right. So that's what they mean by it being kind of like this opportunistic number, where it's like, and again, like here for these quarters, it shows them being consistent, but look at how much lower they are: 100 million, 300 million, 400 million, 200 million, 200 million, 900 million. Right. So that's why they're like, guys, please just look through this 900 million right here. That's what they're asking you to do. Like, please just look through this 900 million. And I think that's reasonable. I think that's not an unreasonable thing to do. Like, for example, if we look at this on average across all these quarters, including the zeros in the averaging, we get about 280. So it's like, what would it be like if we assumed all of these quarters were just 280 instead? In fact, I mean, we could do that. We could do a quick little thought experiment where we just do 280 there across all these on average, which means that the total amount of sales across all these quarters ends up being the same amount. We've just shifted when they arrive. And what does it show then on the chart? We're now at a peak sales level, right? And you can see now that those lines look almost the same. That's because now they are almost the same. They're still 280 different from each other, but now the movements are exactly the same. So yeah, that's kind of what I mean. Now let's revert those numbers back because this is the data set. I don't want to alter the data set. But the point is, like, I could show you that that's kind of what I mean, where they're like, please just kind of like look through that lumpiness, would you please? And I think it's reasonable. I think that's not an unreasonable argument. Like I said, like I would quibble with the MIGAs maybe, but I don't quibble with the funding agreement. So the point is this is me making the case for why they really potentially have solidly turned the corner this quarter, and I think the market potentially recognizes that as well. In fact, coming over to the stock, we can actually look at the reaction. It did have a nice reaction the day of, you can see, but then it did retrace by the end of day pretty significantly. So you can see like that big candle. Unfortunately, it did the next day. It reports after hours, so it tends to really get the pop the next day because it's a thinly traded stock. So it popped up very much in the morning, but then it did kind of dribble back down pretty significantly by the end of the day. I mean, we're still above where we ended prior to earnings. All days have ended that way prior, but obviously it's been a little up and downish kind of for the last week. So we go to the weekly, it looks a little bit cleaner, I guess. But point is, yeah, people had liked the reaction initially, and then they had their second thoughts a little bit. I still like the reaction, but I guess it comes down to how you feel about the going forward prospect of it. So going a little bit lower into the charts here because I was focusing on these quarterly ones. I do have the trailing 12 months of this. Like this is just the quarterly numbers, but here's the trailing months of the same thing. You can see basically the same logic, but kind of played out in a slightly different way. The peak is in the third quarter here because trailing numbers tend to have a little bit of a lag effect on that. So same logic where it peaks in the third quarter here, and then we're at a low point over here. But if you go to the core numbers, you can see that we are starting to bounce back up more solidly here. But because it is a trailing number, that means that the peak is in the third quarter and the fourth quarter a little bit. And so maybe even for the core one, it might take another quarter or two more quarters before we really get to the peak over there because it's including 2 to 3 more quarters outside of that. But nonetheless, we are at least in a sequential positive territory on a trailing 12 months core sales basis, and a year over year basis as well. So looking at it that way with seasonality factored into it, because trailing 12 months will take seasonality into account as well, then that looks good as well. So then coming down from here below the kind of the income statement stuff, I do also in the net sales stuff, I do include also some balance sheet stuff here as well. We have the AUMs, the percentage retained AUMs, which I kind of already showed a little bit of that chart, which we'll get into the details of, and the quarter over quarter sequential growth of the AUMs. So we can see that every quarter, like clockwork, AUMs are growing. 1%, 1%, 1%, 7%, 2%, 2%, 1%, 4%, 1%. So usually small amounts like 1%, but sometimes a little bit of a surprise quarter in there where it grows a little bit more than another quarter. So on average, maybe about 2% on over the long run there. And that's me looking on a single base. Obviously, we can look at it with decimals in there. It's like 2.3% on a simple average basis. Those kind of weaker quarters tend to average more like 1.3%, while the stronger quarters is maybe like a 5 to 6%. So it's kind of averages out to like a 2.3%, so something like that, whatever you want to think about it as. But on a year over year basis, the year over year AUM growth 11%, 12%, 12%, 12%, 9%, 9%. So very, very good. You could argue maybe it's slowing down a little bit there in those last few quarters, but not a huge pattern to make strong implications on. And then the net new business flow, they also report their actual like outflows and inflows to their AUMs on a relative basis in multiple different fashions. So I'm kind of like monitoring that too, because AUMs can come from multiple things. It can come from the growth of the AUMs from the growth of the asset values, but it could also come from net new business flows. So growth in AUMs is good, but you want to make sure it is coming from business flows as well, not just from appreciation of assets. So what we're getting there, 4%, 3%, 6%, 4%, 5%, 3%, 4%, 3%, 3%, very, very solid. On average, 3.78%, 3.61%. So that's kind of like what we've been getting. It's reasonably consistent. Very, very good. So very, very solid. Then I also have book value per share, book value excluding AOCI, which is accumulated other comprehensive income, which basically that's like a fancy accounting word to say changes in asset and liability values that don't have anything to do with the direct operations of your business. So like interest rates go up, bond prices go down. You have a bunch of bonds on your balance sheet, those bond prices go down. Just because the bond price goes down doesn't mean like the actual value of your balance sheet really changed in a substantial way. So they account for this in what they call other accumulated comprehensive income. And so they're reporting the book value excluding that because they want to say, hey, as either A, interest rates go down and the value of our portfolio goes back up, or over time, as bonds get collected and we then go out and re collect new bonds, we will eventually start to reset our balance sheet up at the new interest rate levels, which will then cause our book value per share to then shift closer to the book value per share, excluding AOCI over time. So the current book value per share, long way of saying that the current book value per share is about $31 per share. And currently they're about $35 per share. So they're trading a little bit over book value, right? You can look at that's kind of important to why I'm bringing this detail up. But they're arguing, hey, the our actual core book value is really more like $43 per share because we've got this like $12 per share of funny accounting that's kind of making it seem like our bonds aren't worth that much. But we're not about to go sell our bonds today. We're actually going to hold them for 5 to 7 years. So there's no point in even talking about what they're worth today. That's basically what they're saying. So 5 to 7 years time, when we collect on the bonds, assuming nothing bad happens, we're going to get $43 per share in actual value back. That's what they're saying. And like I said, over time, the interest rates will reset. And so the market itself will eventually start to reset this number towards this number, which means the book value will start to reset towards that number, which means probably the ratio of the book value per share will also creep within that, which basically that's why I'm kind of explaining this to you is that in a sense, there's almost like a baked in potential appreciation based on this number right here. It's like if you think that the stock should trade at book value, then there's no reason you shouldn't assume that the stock shouldn't appreciate to this price over like the next 2 to 5 years. Like it depends on how long you assume that effect takes to kind of work its way through the system. It's like the natural fundamental process, so you can't rush it per se. It might take up to 5 years for it to really kind of work, but who knows? It could happen a lot faster too. That's the other thing. And also, who says it has to trade at 1 times book value? Why couldn't it trade at 1.25 times book value or 1.5 times book value, right? So that's just something to keep in mind. That it's like, in my opinion, there's a very strong, very easy to understand basis for where a revision in the market value for FG could come from over time based off of just that one mechanic right there. And that has nothing to do with business growth, right? That has nothing to do with business growth. So business growth would be on top of that too, which is where my thesis for it comes down. And then I have the ROA and ROE measures that I was talking about down here. So this gets into those differences I was kind of talking about, which I'll show you on the charts as well. But anyway, so the ways we can think about ROA and ROE. When the company reports their ROA, what they report is their adjusted ROA annualized on an annualized basis. So what they mean is they're taking the adjusted net income for the company for that specific quarter, for just Q2, whatever the adjusted net income, their adjusted number is for that number, and they're multiplying it by 4 because they're annualizing. That's what they mean when they say annualize. They're multiplying it by 4. So it's not a trailing number. It's sort of like saying, what would it, if this quarter represented all of our quarters, what would it look like for the full year? And that's what they do. They multiply it by 4, and then they put that on an annualized basis over their assets under management. That's what they report as their adjusted ROA. And it's currently 0.76, give or take. I think that even the way I'm calculating is slightly different from them because I think I made an assumption from their adjusted EPS based off of their diluted average share count. So even the number I'm reporting here could be like 1 or 2 basis points off of what they reported. It might be like 77 or 78 basis points even, but whatever. Like I said, so many quirks to how you could literally report this number. So I reported that here, but I also said, well, okay, that's if you annualize the current quarter, which doesn't take seasonality into account. And the reason why they want to do it is because they sort of want to give themselves credit for any improvement in the ROA. If you improve your ROA over this quarter and last quarter, or this quarter and next quarter, you don't want to wait all 4 quarters for you to start to feel that effect in the trailing number. And so you want to say, hey, we're already starting to improve, and I can show that to you by annualizing the number here. But likewise, if it gets worse, it shows up immediately too. So like here, we went from like 1.14% on an adjusted ROA annualized basis in Q4 2024 down to almost half that in the first quarter of 2025. So you can see like what gives with one hand can be taken away with the other in terms of annualizing that number. But if you look at it on a trailing 12-month basis, you don't get that kind of jump. It went from 1.09 to 0.97. So it went down in that same quarter, but it went down much slower because there's a trailing 4 quarters that have to be calculated into that on that sort of trailing basis, right? So that's what that is here. But then I did also include the gap ROA numbers on an annualized and trailing 12-month basis, because this is with the adjusted ROA, right? So I could also use the gap net income, but they're giving me their ROA, but I could also use gap ROA. And then also technically, by the way, what they're doing is when they say ROA, meaning return on assets, they're doing it as a percentage of their assets under management. They're not even doing it as a percentage of their total assets. They're actually just doing it over their assets under management. So that's like another thing that would make them different from gap. And even when I report the gap number here, I didn't adjust for that. I still kept it as the assets under management. I decided just to let it be for that part. Their assets under management, is worth noting, do make up like 80% of their assets or something like that. That might even be conservative. It might be higher than that too. So whatever. But the point is, I'm just trying to show how, don't quibble over a couple basis points with the ROA number. Like, it doesn't matter. It doesn't matter, because it comes down to how you calculate it. It's like, I care much more about a much larger difference, and I care about the pattern over many quarters than anything. So anyway, then I also have the ROE number here. I'm using the adjusted one. I didn't use a gap number for that, but the adjusted ROE on both an annualized basis for the current quarter, but also on a trailing 12-month basis. Kind of the same argument, but in this case, you're doing it with equity rather than with the book value, rather than with the assets under management. And in this case, also with the way that they report it, they use the book value excluding the accumulated other comprehensive income. So it's worth noting. See, like, that's another quirk of how they're doing it, where they're saying, well, don't focus on that part that is really just accounting silliness. Our real ROE, when if you look through to our core business, the real ROE is like this, you know. So it's kind of, like I said, funny way you could calculate. So it's like, depending on how mean or how nice you want to be to the company, I could increase the ROA by a factor of 2, or I could cut it in half. Like, depending on how you want to be towards it. Then coming over to look at the charts of basically the same information that I've kind of explained a lot of that. Sort of look at it. Here's the AUMs before and after reinsurance. So the orange line is the AUM growing before reinsurance. That's like the total amount of AUMs that they are responsible for. And then the blue line is the amount that they actually have on their balance sheet, because the rest of it, the gap between it, is the amount that they've essentially sent off to the reinsured. And then the green line is the ratio between two, like I showed. And I was saying, like, you see, it's coming down over time as they add more reinsurers. And then also, as I mentioned before, the sales they did in the first half of the year this year were retained at a 70% ratio, which is even lower than where the green line is on a total basis. So it just shows that, like, they are moving that line downward even more over time. And then over here, I show the blue line is the net new business flow. So here you can see, like, in millions of dollars. So you can see it's like 2 to 3 billion or so. You can see per quarter over here. Is that a trailing 12-month? No, that's in the quarter. I think that's just in the quarter. Yeah, yeah. I had to remind myself there for a second, which didn't label it. See, it's important to label all these things sometimes. Percent delta. So then percent delta, uh, that's relative to the assets under management before reinsurance. So yeah, that's basically saying, like, if I was to think about that as percentage growth, what would that be? It's like, there's the net new business flow in terms of millions and billions, and then here's it in net as percent delta, meaning what is the percent change relative to the total assets under management before reinsurance. So we're calculating on a before reinsurance basis for this. So you can see the gap is widening over time as this gap widens. So you can see, like, that's kind of what's going on there. And then the QOQ number is the sequential increase in the assets under management. So that was one of the things I kind of wanted to say, is, like, as I was showing before, it's like net new business flow is kind of different from the growth in assets under management. Like, you want the assets under management to be positive, but you also need the net new business flow to be positive, or at least you need to be super, super aware if it's not. Technically, it doesn't have to be positive. It will eventually not be positive, but we don't want it to be not positive for several years at least. Like, that's a it's if that blue line goes negative, it starts to break the thesis. Like, that's a that's not good. That's not good. So yeah, we want it to be up here 2 to 4% or even higher. So assets under management will flow through in that sense kind of over time, but it has other things on it. Then here, as I was kind of promising, we have the ROA and ROE quarterly annualized. So here's the quarterly numbers. The gap ROA annualized, you can see it shoots all over the place. One, because it's gap, and two, because it's an annualized number. So the annualized number means it has that seasonality aspect that makes it shoot all over the place, but also it's gap net income. So it shoots up and down all over the place, which means it doesn't give you a very core read, which maybe makes you understand why somebody would want an adjusted number. Because look at how stable the adjusted number is relative to that all over the place thing. And they're both on this left hand side axis. So they're both on the same axis. The ROE one here is on the right hand side. The one is the blue and the orange are both on the same line, and yet the orange one's much more stable, as you can see, much more stable around 1% or a little bit below 1%. Is about where it currently. And yes, we would like to see that push above 1%, much more stably if we could. And then the adjusted ROE, you can see, is much less stable than the orange line, but that's also because it's an equity ratio, not an asset ratio. So this has leverage built into it. All of that leverage of their liabilities, which they're levered like 15 to 20 to 1 or so, give or take. So yeah, it's going to push it much more higher, which is why we go from like 80 to 90 basis points to then 7.1% in the most recent quarter, right? It's a massive leveraging up of that number overall. And then looking on a trailing 12-month basis, it kind of gives you a similar picture, but also a lot more stable, because that trailing 12-month part takes out the seasonality kind of volatility within it. But you're still the gap volatility. You can still see the gap volatility here. But then the adjusted ROA, much more stable, as we were talking about at less than 1%. But on a trailing 12-month basis, it sure looks like it's on a little bit more of a solid uptrend, doesn't it? Than it maybe looks like on this kind of quarterly basis. Hard to say 100% for sure, but we'll see if it's still hovering more solidly around the 1% line a year from now, then that would be nice. That would be very nice. And then on a trailing 12-month basis for the ROE number, kind of similar, of a much more solid, consistent uptrend look, but we'll see. We'll see a year from now if it manages to kind of hold around this area, or if it really just kind of retraces back down to below here. But my thesis certainly believes that we're going to hold this area much more forward. And I do think that some of the aspects of what I was talking about with the book value and the working through of the interest rates differentials on the accumulated other comprehensive income is related to that, because they did have to book a lot of negative costs in terms of the mark to market aspects of their business related to that. So that did have its impact on their ROA and ROE itself. But here you can see that what I was talking about with that book value here. The book value excluding AOCI. So here's like what their book value could theoretically be if everything was repriced to as it is essentially really sort of is on an operating basis. And then here's the actual book value as it's reported on a gap basis. As you can see, is like, yeah, this gap is closing over time. It got widened because of 2022, and then it's starting to close over time. It can close faster if interest rates go down, but it doesn't require the interest rates go down. It just requires time for it to go down. But as this gap closes, the stock should get a re-rating to its price to book multiple theoretically time. Then against that, I have the Q over Q sequential change in that. So here you can kind of see the changes between both of them. For the AOCI, which is kind of the core business level, you can see 6%, negative 7%, 2%, 3%, negative 1%, 5%, negative 2%, 0%. So like we really do want to see that moving up over time. It's obviously moves up, but it moves up kind of slowly. The gap one is moving up faster, but that has to do with the gap existing. It's like if this AOCI didn't exist, well, then they would grow at basically the same rate. So we would like to see this grow faster, but this will grow faster with faster revenue growth and also with more reinsured sidecars. That actually helps to improve the book value growth as well, because that means that they can, grow their assets at a faster clip than they're growing their liability. So yeah. Is there any other details? I think I already said all the details from the call that I had for that. Okay, so that's pretty much all my thoughts on FG and really all my thoughts on all those major players in my portfolio. So yeah, we talked for almost 2 hours. Pretty good long talk there. I think a few viewers popped in here and there, and Dan was in the chat there a little bit, but definitely a quiet day, which is fine. Whatever. Had a lot of stuff to talk about, partially because my schedule's been weird and funny, but I'm sure a few of you will watch it on the replay, especially considering FG has been a major topic for it. But I will remind viewers who are watching on the replay, it would be really appreciated if you'd like the stream, subscribe to the channel if you're not already, hit the notification bell, join the free Discord if you haven't already. Consider throwing me a PayPal or a Patreon if you feel like supporting me in any sort of monetary way as well. Links are in the description below. But otherwise, we'll look forward to our next chat in 2 weeks' time. I will hopefully try not to miss that one as well. So we'll actually keep to a 2 weeks one, which as I had said like a month ago or so, when I was kind of talking about how I kind of have like a schedule sort of in place for like what shows I want to do on kind of what order. I was planning to do kind of 2 to 3 shows covering earnings season each season, and this is the second one, but it's probably going to be the second and last one for this earnings season. This earnings season's basically over, as I kind of mentioned at the start of the show. My companies are certainly over, so we did one show kind of covering broad earnings season of other companies, and then we did one show covering my companies in its core. But yeah, hopefully in 2 weeks' time, we'll probably have a topic, have a show where we're kind of covering my portfolio and maybe some details related to specific companies in my portfolio a bit more. As I was kind of talking about at the start of the show, I've been changing my watch list around. I've been changing my portfolio spreadsheet around. I've been changing my valuation templates around. I've been changing a lot of my strategies around a lot, honestly, this last year for a variety of reasons. So maybe I'll get into some of the details of that in a couple weeks' time. But either way, I appreciate you all who watch, and I'll catch you all in the next one.